Hello everyone and welcome to our channel. Today's topic is Best 5 ETFs in 2025. What's an ETF, you ask? ETF stands for Exchange Traded Fund, and it's a type of investment fund and exchange traded product. ETFs are traded on stock exchanges, much like individual stocks. However, unlike individual stocks that represent a stake in a single company, an ETF holds assets such as stocks, bonds, or commodities, essentially providing you a way to invest in a broad sector or market. The importance of ETFs is quite significant in the investment world. They offer a way for investors to diversify their portfolios without having to buy each individual stock or bond. This is because an ETF represents a collection of different assets. By owning an ETF, you're essentially spreading your investment across many different companies or sectors, which can help to mitigate risk. Moreover, ETFs have become incredibly popular due to their flexibility. Unlike mutual funds, which can only be bought or sold at the end of the trading day, ETFs can be traded throughout the day just like stocks. This means you can buy or sell ETFs anytime during the trading day, giving you more control over your investments. Now let's talk about the stars of our show today. The 5 ETFs that we believe are the best for 2025. These are SPY, VOO, IVV, VTI, and QQQ. Each of these ETFs represents a different segment of the market and has its own unique benefits and risks. SPY tracks the S&P 500 index. VOO also follows the S&P 500, but with a different management style. IV is yet another ETF that tracks the S&P 500. VTI gives you exposure to the entire US stock market, and QQQ focuses on the tech-heavy NASDAQ 100. So why these 5? Well, they offer a mix of broad market exposure, sector-specific opportunities, and different management styles. But we'll get into the nitty-gritty of each in the following scenes. Stay tuned as we delve into each of these ETFs and figure out why they might be a great addition to your portfolio in 2025. Hello viewers, if you're enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. First on our list is the SPY ETF. The SPY ETF, also known as the Spider S&P 500 ETF Trust, is one of the most popular and widely traded ETFs in the world. This ETF seeks to track the performance of the S&P 500, a benchmark index for large-cap US stocks. It's like buying a little slice of the 500 largest publicly traded companies in the United States. The SPY ETF has been a consistent performer over the years and has a reputation for providing investors with steady returns. It has a long track record dating back to January 1993, making it the oldest ETF in existence. This longevity speaks to its reliability and stability. The SPY ETF provides several key benefits to investors. First, it offers broad exposure to the US stock market. This means that by purchasing shares in the SPY ETF, you're investing in a diverse range of sectors, including technology, healthcare, financials, and consumer discretionary, to name a few. This broad diversification helps to mitigate the risk associated with investing in individual stocks. Another advantage of the SPY ETF is its liquidity. As one of the most heavily traded ETFs, it's easy to buy and sell shares, making it a suitable choice for both long-term investors and those who wish to trade more frequently. However, like any investment, the SPY ETF also carries potential risks. Market volatility can affect the value of the ETF, and because it tracks the S&P 500, any downturn in this index will be reflected in the ETF's performance. It's also worth noting that while the SPY ETF offers broad market exposure, it's heavily weighted towards the largest companies in the S&P 500. So, if these companies perform poorly, the ETF could be negatively impacted. But despite these potential risks, the SPY ETF is held in high regard in the investment community. It's often recommended as a core holding in a diversified portfolio due to its broad exposure, liquidity, and historical performance. It's also worth noting that the SPY ETF has a low expense ratio, which means more of your money goes towards your investment rather than fees. In conclusion, the SPY ETF offers a way for investors to gain broad exposure to the US stock market, with the added benefits of liquidity and a low expense ratio. However, as with all investments, it's important to consider your personal financial goals and risk tolerance before investing. That wraps up our discussion on the SPY ETF. Next, we'll look at VOO. The second ETF on our list is VOO. Diving right in, the VOO, or the Vanguard S&P 500 ETF, is a powerhouse in the exchange-traded fund world. As the name suggests, this ETF tracks the S&P 500 index, consisting of 500 of the largest U.S. companies. The VOO offers a simple, cost-effective way to gain exposure to a wide cross-section of the U.S. equity market. It's like buying a little slice of the American economy. So what's the performance been like? Well, over the past decade, the VOO has consistently delivered robust returns, mirroring the general trajectory of the U.S. stock market. Of course, as with any investment, past performance does not guarantee future results. But the steady growth of the VOO over the years has cemented its reputation as a reliable choice for investors. Now let's talk about the sectors it covers. The VOO is a broad market ETF, meaning it covers a wide array of sectors. From technology giants to healthcare behemoths, consumer goods to financial institutions, the VOO has it all. This broad exposure is what makes VOO a diversified choice, helping to spread risk across different sectors. One of the main benefits of the VOO is its low expense ratio. In the world of ETFs, the expense ratio is a key factor to consider. This is the fee that you pay to the fund manager, expressed as a percentage of your investment. The VOO has one of the lowest expense ratios in the industry, making it an attractive option for cost-conscious investors. Another advantage is its liquidity. With a high trading volume, the VOO is highly liquid, meaning you can buy or sell shares with ease. This liquidity, coupled with its broad market exposure, makes the VOO a popular choice for both individual and institutional investors. But as with any investment, the VOO comes with potential risks. The most significant of these is market risk. Since VOO tracks the S&P 500, if the market takes a downturn, so will your investment. Also, while its broad diversification helps spread risk, it also means you could miss out on higher returns from specific sectors that outperform the market. So what's the overall market reputation of the VOO? Well, it's generally seen as a solid, low-cost option for investors looking for broad market exposure. It's particularly popular among passive investors who want to buy the market without having to pick individual stocks. In summary, VOO is a well-rounded ETF with a strong track record, low costs, and broad market exposure. Whether you're a seasoned investor or just starting out, the VOO offers a straightforward way to invest in the U.S. stock market. That's all about VOO. Up next, we have the IVV ETF. Next on our list is the IVV ETF. The iShares Core S&P 500 ETF, more commonly known as IVV, is another prominent player in the ETF universe. It's known for its broad market coverage and low costs, making it a popular choice for many investors. But let's delve a little deeper to see what this ETF really brings to the table. IVV is designed to track the S&P 500 index, which comprises 500 of the largest U.S. companies. This means when you invest in IVV, you're essentially investing in a cross-section of the American economy. From technology to healthcare, from financials to consumer goods, IVV covers it all. It's like owning a little piece of the entire U.S. stock market. One of its standout features is its low expense ratio. When it comes to investing, every penny counts, and the less you pay in fees, the more of your money gets to work for you. IVV's expense ratio is just 4 basis points, which is extremely competitive within the ETF landscape. This means that for every $10,000 you invest, you'll only pay $4 in annual fees. Over the past decade, IVV has shown remarkable performance. It has consistently delivered strong returns, closely mirroring the performance of the S&P 500 index. This is largely due to its broad diversification, which helps to spread risk and potentially smooth out investment returns. However, like any investment, IVV comes with its own set of risks. The most prominent of these is market risk. Because IVV is designed to mimic the performance of the S&P 500, if the overall market takes a downturn, IVV will likely follow suit. Additionally, because it's heavily weighted towards large-cap stocks, it may underperform in times when smaller companies are outperforming the market. But despite these risks, IVV maintains a solid market reputation. It's lauded for its transparency, liquidity, and tax efficiency. Its wide diversification across sectors can also help to reduce the impact of any one company or sector underperforming. In conclusion, IVV is a strong contender for those seeking broad market exposure at a low cost. Its robust performance, wide diversification, and low expense ratio make it an attractive option for many investors. However, as always, it's important to consider your own investment goals, risk tolerance, and time horizon before making any investment decisions. That concludes our discussion on IV. Let's move on to VTI. Now let's talk about the VTI ETF. Moving on to our fourth ETF, the Vanguard Total Stock Market ETF, better known by its ticker symbol VTI. It's a fund that's earned a reputation for its comprehensive coverage of the U.S. stock market. It provides investors with exposure to a broad array of companies across many sectors, making it a popular choice for those looking to diversify their portfolios. VTI tracks the performance of the CRSP U.S. Total Market Index, which includes nearly every publicly traded U.S. company with a market cap above $25 million. This means that when you invest in VTI, you're essentially buying into the entire U.S. stock market. That's right, from small startups to the largest blue-chip companies, you've got them all in one neat package. Historically, VTI has demonstrated a strong performance. Since its inception in the year 2001, it's consistently provided investors with solid returns. While past performance isn't a guarantee of future results, it does provide a measure of confidence in the fund's ability to navigate various market conditions. One of the key benefits of VTI is its low expense ratio. Vanguard, the fund's manager, is known for its commitment to keeping costs low for investors, and VTI is no exception. This means more of your money stays invested and continues to work for you. Another benefit is its diversification. With VTI, you're not just invested in one sector or type of company, you've got a piece of the entire U.S. stock market. This can help to reduce risk, as losses in one sector could potentially be offset by gains in another. However, it's important to note that while diversification can help to reduce risk, it doesn't eliminate it. Investing in VTI still exposes you to the overall risk of the U.S. stock market. If the market as a whole declines, so too could the value of your VTI shares. VTI's reputation in the market is largely positive. It's often recommended for its broad exposure and low costs. Many consider it a core holding for any portfolio, especially for those who prefer a passive investing strategy. But like all investments, VTI isn't without its potential downsides. The very thing that makes it attractive to some investors, its broad market exposure, could be a drawback for others. If you're looking to target specific sectors or prefer a more active investment approach, VTI might not be the best fit for you. In conclusion, VTI offers a simple and cost-effective way to gain broad exposure to the U.S. stock market. It's a fund that has demonstrated solid historical performance and offers the benefits of diversification. However, like any investment, it comes with potential risks and isn't suitable for every investor. That's all for VTI. Finally, we have the QQQ ETF. Last but not least, let's discuss the QQQ ETF. Now, if you're not familiar with QQQ, it's the ticker symbol for the Invesco QQQ ETF. This exchange-traded fund is designed to track the performance of the NASDAQ 100 index, which includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market. As such, the QQQ ETF is heavily weighted towards the technology sector, but it also covers consumer discretionary, healthcare, and communication services, among others. Now let's talk about the performance of this ETF. Historically, QQQ has been a strong performer, consistently delivering solid returns. For instance, in the past decade, the fund has consistently outperformed the S&P 500. This is largely due to the fact that the NASDAQ 100 index is heavily weighted towards the tech sector, which has been a high-growth sector over the past few years. However, past performance is not an indicator of future results, and it's essential to consider potential risks. The heavy weighting towards technology means that the QQQ ETF is more susceptible to downturns in this sector. If tech stocks suffer, the QQQ ETF could see significant losses. Moreover, because it's an index fund, QQQ doesn't offer the same level of diversification as some other ETFs. That being said, the QQQ ETF has a strong market reputation. It's one of the most widely traded ETFs in the world with a high degree of liquidity. This means that you can buy or sell shares of the ETF quickly and at a fair market price. The ETF also has a relatively low expense ratio, making it a cost-effective choice for many investors. The QQQ ETF's focus on the NASDAQ 100 also gives it a unique position in the market. It offers exposure to some of the most innovative and fast-growing companies in the world. This includes giants like Apple, Amazon, and Google, but also smaller, up-and-coming companies. So is the QQQ ETF right for you? Well, that depends on your investment goals and risk tolerance. If you're looking for exposure to the tech sector and are comfortable with the associated risks, it could be a good fit. However, if you prefer a more diversified portfolio, you might want to consider other options. Remember, it's always important to do your own research and consider your financial situation and investment goals before making any investment decisions. That concludes our list of the best 5 ETFs for 2025. We've now covered the best 5 ETFs for 2025. In our journey today, we've explored the depths of SPY, VOO, IVV, VTI, and QQQ. Each of these exchange-traded funds offers a different avenue to financial growth, and hopefully we've shed some light on the unique benefits and potential risks associated with each one. Let's take a moment to recap. The SPY ETF, also known as the Spider S&P 500 ETF Trust, is one of the most well-known and widely traded ETFs out there. It's a fantastic option for those wanting to mirror the performance of the S&P 500. Next, we dived into the Vanguard S&P 500 ETF, or VEO. With its low expense ratio and high liquidity, VOO is a great choice for those who want to track the S&P 500 index while keeping costs low. We then navigated the waters of the iShares Core S&P 500 ETF, IVV. Similar to SPY and VO, EV also tracks the S&P 500 index, but does so with a unique twist of its own. The Vanguard Total Stock Market ETF, VTI, came after. This ETF offers exposure to the entire U.S. equity market, making it a one-stop shop for broad market coverage. And last but not least, we explored the Invesco QQQ ETF. QQQ focuses on the tech sector by tracking the NASDAQ 100 index, making it a go-to choice for tech enthusiasts and growth-focused investors. Remember, while these ETFs are some of the best options available in 2025, the importance of diversification cannot be overstated. Don't put all your eggs in one basket. Spread your investments across different assets to minimize risk. And finally, always conduct your personal research before investing. Markets are constantly changing, and what works today might not work tomorrow. Stay informed and stay ahead. Remember to subscribe, like, and share our video if you found it useful. Thanks for watching, and until next time, happy investing.